Welcome back, everyone. Sean Stevens here again with Metroplex Mortgage Services, bringing you another divorce mortgage planning video quick tip. In my recent post on alternative income and divorce mortgage planning, we discussed how self-employed clients may not always qualify under traditional mortgage documentation standards. Today, we'll explore one specific alternative, the business purpose loan, and how it may apply when a divorcing client owns investment real estate through an LLC or when loan proceeds are used primarily for a business purpose rather than consumer use. Understanding this distinction can help family law attorneys structure settlement terms that align with mortgage lending guidelines and preserve post-divorce financing options. But before we get started, don't forget to download our Divorce Lending Blueprint for Success with a link below. This is a step-by-step resource designed to help attorneys and homeowners navigate the refinance and purchase process during divorce. For mortgage qualifying purposes, a business purpose loan is defined as an extension of credit primarily for a business, commercial, or agricultural purpose. In simpler terms, this means that a loan is not intended for personal, family, or household purposes, but instead one where proceeds are primarily used for a non-consumer business purpose and not a covered transaction, as provided for under the Truth in Lending Act. This is important because business purpose loans can provide flexible alternatives for loan qualification and documentation, which may be favorable to investors and self-employed individuals. Common question we receive is, can a business purpose loan be closed in the name of an LLC? One of the key distinctions of a business purpose loan is that it can close in the name of an LLC, whereas traditional, conventional, and government loan programs must close in the individual borrower's name. This flexibility can be especially useful for business purpose credit situations where the property is owned by an LLC for liability or tax planning purposes, a divorcing spouse operates a business and uses the property for income generation, and the refinance or buyout involves investment property rather than a primary residence. Because these loans are structured as business credit, underwriting typically relies on property cash flow analysis, not the standard W-2 or tax return documentation used for Fannie Mae, Freddie Mac, FHA, VA, or USDA loans. For family law attorneys, recognizing when a business purpose loan applies can prevent settlement complications and financing delays. Understanding this loan type helps you clarify property classification, differentiate between personal or investment property, anticipate financing feasibility for settlement options, avoid delays when property is held in an LLC or used for a business purpose. For example, if one spouse owns rental property through an LLC and plans to retain it post-divorce, a traditional refinance may not be possible or necessary. Instead, refinancing with a business purpose loan could provide liquidity, debt separation, or access to capital, all while keeping title under the business entity. Family law attorneys should remember the following. This is not a consumer loan. Business purpose loans are not subject to the same documentation standards. They can close in an LLC, which is ideal for an entity held, investment, or business use properties. Underwriting guidelines focus on property cash flow and business purpose rather than personal tax returns. And for divorce mortgage planning, this is useful when settlement terms involve LLCs, business entities, or investment real estate. Divorce-related financing often blurs the line between consumer and business credit. When LLCs, investment properties, or self-employed income come into play, having a certified divorce lending professional on your team ensures your settlement terms align with lending requirements. And remember, work with a team that understands both mortgages and divorce. At Metroplex Mortgage Services, our divorce lending practice group works alongside family law attorneys to draft lender-compliant settlement terms, preserve client eligibility for equity buyouts, maximize equity and available loan options, provide expert insight on credit qualifying, income analysis, and loan requirements. Whether you're drafting the MSA or troubleshooting post-decree financing, we can help ensure mortgage eligibility aligns with settlement intent. If your client intends to keep the home, early planning makes all the difference. Contact us to review options, assess qualifying limits, and ensure enforceable mortgage compliant terms. And to our valued family law partners, thank you for the continued referrals and the trust you place in our divorce lending practice group. We're proud to serve as your partner for navigating mortgage-related issues during divorce. As always, I want everyone to make it a great day and look forward to seeing you right here for the next tip of the week.